Hi, it's Mark again for Realty Capital Finance, making now video number 6 in the series, an educational series for borrowers and brokers on how we operate. I will be discussing now the entity. Typically, our loans, there is a borrower and a guarantor. The borrower is the entity or individual. Typically, it is the entity that is borrowing the money, and then the guarantor is the individual who is typically behind the LLC who is guaranteeing the loan. Now, with entities, there's many. There are LLCs, limited liability corporations, there are straight up corporations, and there are trusts, and sometimes individuals. An individual is just basically a person. If we choose to have an individual be the borrower, then we don't need any of the documents I'm going to discuss. We always need the identification, so that's typically all we need. But let's discuss LLC, and let's discuss corporation, and let's discuss trusts. Now, LLCs are basically limited liability corporations. There are typically 4 documents that are necessary for us to be reviewed to make sure that the entity is legit and in good standing. There is the Articles of Incorporation, or known as AOO, which is basically a document you get from the state when you create this entity, you incorporate, you get a receipt. It basically states the date, the name of the company, and the state identification. It is called the Articles of Organization. It is the AOO, which makes the creation of the entity. The next document is the operating agreement, which is typically several pages long. That is how the entity is going to operate. Who's the managers, who has authority, voting rights, this kind of stuff. We don't need fancy operating agreements. On the contrary, we prefer they be simple. And what we do need to have to see that there is no conflict in the individual who is going to be the guarantor taking out the loan on behalf of the entity. We need to make sure that in the operating agreement there's no conflict, or that it states specifically that they are allowed to do that. Now, many times there are borrowers that are partners in an entity, and we are dealing primarily with one of the guarantors. So let's say John and Jane. If Jane is the primary individual we are dealing with, who is going to be the guarantor, it must stay in the operating agreement that Jane is allowed to take out this loan on behalf of the entity, and John agrees. Sometimes we have additives that we add a revision to the operating agreement stating that. The next document that we require is a certificate of good standing, which basically states that the entity, the limited liability corporation, is still in effect in the state. Every year, when you make a LLC, in order for the state not to have numerous LLCs that were opened and never were used as an actual entity, every year they require you to file again with the state that the entity is still in good standing. It's called a certificate of good standing, or for short, COGS. Now, certificate of good standing, typically most states have a website. You can go and order one. It's got to be legit. It has to say the entity number from the state on it. Most of the time, we require it to be dated less than 90 days ago. Even if at the beginning of 2020, you filed with the state to keep your entity alive, now that it is, say, June 2020, we will require a new one dated within the last 90 days to be valid. The last document required is the IRS EIN number, which is basically the social security number, so to speak, of the entity. It's a tax identification number. We do require the original one. We greatly prefer to receive the original one. When you create a entity, you then create a EIN number with the IRS. They will email you then basically a 2-page document saying this is the corporate identification, tax identification number. We greatly prefer to have that one. If that's not available, there are other ways of getting it. Either from the states. Many states allow you to part of the. If you look up the entity on the state website, they will list the tax ID number. We will allow that as well. Now I'd like to discuss corporations. Corporations have 2 changes. Certificate of good standing is the same, and IRS EIN number is the same, as well as Articles of Organization is the same. The incorporating documents. The sole difference, I believe, generally in a corporation to to a LLC is that they don't have what's called a operating agreement. It's called bylaws. It essentially does the same thing, but we will require signed bylaws. Now, I want to state before I discuss trusts that we require, as with all our underwriting, whether it's title, insurance, appraisals, LLC docs, we require everything to be 100% clear and legit. We require professional copies. We don't want pictures of documents. We want dates to be correct, signatures to be correct, spelling to be correct. Often we get copies of operating agreements that are unsigned. No, we want it signed. Everything should be official. Nothing we ask for is arduous. It's all simple stuff. It just needs to be done correctly. Now, trusts. Trusts are basically where you have a trust where a property is put into a trust, typically in a will, and there are trustees. There are people who run the trust, usually the children of the deceased. A trust typically has an agreement. We can lend to trust typically. It doesn't require any of the certificate of good standings or the articles of incorporation, but we do need the trust agreement. It must be signed and dated, obviously, and typically the trust also has a IRS EIN that we will require. Sometimes, I just want to discuss, sometimes we run into issues, and there have been loans that we have done that were somewhat challenging, where there was a LLC that belonged to another LLC or a corporation that belonged to an LLC. We will work to get through it. It sometimes will take time for our legal team to unpack it all and make sure that they clearly understand exactly who is responsible. There is something called a series LLC. Typically, we will not lend to a series LLC. A series LLC, in short, is basically we have a larger LLC that owns numerous LLCs. We won't lend to, and we're lending to one of the small LLCs within the family of LLCs because we don't understand the liabilities necessarily of all the other minor LLCs that are under the parent LLC. And therefore, we typically will not lend to an LLC. We almost always desire to have a specific LLC or corporation created for this property, for this loan. That is almost always the clearest way to go. If there is a older LLC or corporation that is already in operation but is simple and is not part of a series, we will not have a problem with that. This concludes the information on entities, LLCs, corporations, and trusts. If you have any questions, as always, please don't hesitate to comment on the video. I will get the questions and I will respond.